The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan with the weekly perspective for the week ending February 2026. Well, on the landing page, we've definitely simplified the website, try to make it easy for everybody. And if you're not familiar with it, step 1, sign up for the free newsletter. Step 2, we have 2 documentaries, Silver Sunrise, which completed late last year. It's for free. Just click there, watch it. And The Four Horsemen. Over a decade old, but it really does tell you what's really going on and how much power the money elite have over society at large. And more importantly, the age of empire, how empires rise and fall. Step 3 is for people who are interested in our premium service, and consultations are up here. So let's get moving with something I found rather interesting for this weekly perspective. What you're looking at is obviously highlighted portion of a paper that came out, and this was sent actually from a friend of mine. It's a summary of the U.S. Embassy's London cable, December 10th, 1974. Dealers' expectations regarding gold futures market. And the classification was limited official use. Put this into context. The cable was sent to the U.S. Embassy in London shortly before U.S. citizens were once again permitted to legally own gold, which was effective January 1st, 1975. At that time, discussions were underway regarding the establishment of a formal gold futures market in the United States, which would materialize on the Comex in 1975. The embassy surveyed major bullion dealers in London to assess how a gold futures market might affect physical demand, pricing behavior, and investor psychology. The core findings of this cable was first, futures markets would be dominated by paper trading. Dealers expressed the view that gold futures markets would consist primarily of speculative conditions. Physical delivery would represent only a small fraction of the total contract volume, and the majority of participants would trade contracts rather than take possession. Large contract volume versus small physical turnover. The cable also noted futures trading volume would likely be large, but actual physical trading would be minuscule by comparison. Cable also stated that dealers believed that a futures market would dampen volatile price movements, and liquidity could be absorbed by buying and selling pressures that might otherwise hit the physical market. And lastly, possible reduction in physical hoarding by U.S. citizens. Perhaps the most discussed section of this cable was dealers believed a futures market could diminish initial physical demand once U.S. ownership was legalized. Long-term coin demand expected. Dealers predicted initial strong coin demand. After that surge would moderate, and U.S. mint production could likely meet coin demand if required. It's important to note that the cable does not present a directive or a policy to suppress gold prices. Rather, it reports dealers' expectations before it actually occurred and market forecasts. The reason this document is frequently cited is the cable often referenced because it acknowledges clearly before the launch of U.S. citizens buying gold again, paper trade was expected to dominate. Physical delivery would be a small subset, and futures markets could influence physical demand dynamics. So I think I just leave it that simple. I'll post this up on Twitter so you can see the document, and you can search it. It's kind of hard to find. It took me a while, but I did find it. And there's a lot going on in the market. I guess just make a few comments. Silver had a very good week, especially Friday, and we are still in price discovery mode. A lot of people are talking about this next delivery month and what's going to occur. I'm going to remain neutral. Obviously, a lot of metal has come off the exchange, or I should say out of the exchange, which is more important than just moving tags around within the exchange. But we'll see. There still is something like 86 million or something, last time I checked, million ounces in the registered dealers category. So that's a pretty good amount of metal. We'll see what happens. I will be back with you next week with another weekly perspective.
The US government debt is about to cross $37 trillion. That's not a typo, that's trillion with a T. Tariffs are being used to try and even the playing fields. Global supply chains are shifting. Inflation isn't going away. And the value of your dollar? It's quietly being drained while no one is really talking about this. The truth is, we're living through the early stages of a financial reset, whether anyone wants to admit it or not. And if you're still relying on mainstream headlines or financial advisors who just tell you to write it out, you could be blindsided when things really shift. That's where the Morgan Report comes in. For over 25 years, David Morgan has been helping investors cut through the noise. He tracks what actually drives markets, from precious metals and mining stocks to global debt and monetary policy, and show you how to protect and grow your wealth when the system is under stress. This isn't just about gold and silver. It's about having a clear-eyed view of where things are headed and making sure you're not caught off guard. The Morgan Report gives you real research, honest analysis, and strategies you can act on, even in a world of rising debt, unstable currencies, and economic uncertainty. Go to themorganreport.com today, download your free report, get informed, get ahead, and take back control of your financial future. Themorganreport.com, because $37 trillion in debt won't fix itself.